What is happening, crypto champions? Get ready for a rapid-fire download of the news that's shaking up the digital asset space. The market is moving at warp speed, and if you're not plugged in, you're missing out. Today, we've got insights from a Wall Street legend about massive potential swings. We're also diving into a groundbreaking look at how two of the hottest tech trends are merging, and what that means for the future. Plus, we've got a deep dive into what the big players are doing with their digital fortunes, and a crucial look at the philosophical battles shaping the future of this entire ecosystem. Buckle up, because this is the Bitcoin Bulletin, and you're about to get the unmissable updates you need to stay ahead of the curve. Let's dive in. Make sure to hit that like button, subscribe, and ring the notification bell so you never miss an update. A 40% drop before $500,000. That's the bold prediction from a Wall Street titan. In the ever-turbulent world of digital assets, where fortunes can be made and lost in the blink of an eye, a prominent voice from traditional finance is offering a stark outlook on Bitcoin's future trajectory. Anthony Scaramucci, the founder of Skybridge Capital and a seasoned Wall Street veteran, has recently shared his perspective, predicting a significant potential downturn for Bitcoin before it reaches an astonishing milestone of $500,000. This forecast, while seemingly contradictory, is rooted in Scaramucci's deep understanding of market volatility and his belief in the long-term potential of the cryptocurrency. Scaramucci, no stranger to the intricacies of financial markets, acknowledges that volatility is not just a characteristic, but an inherent part of the cryptocurrency landscape. He emphasizes that, for investors looking to capitalize on Bitcoin's growth, preparedness for market fluctuations is paramount. His advice is clear: embrace the long-term vision and steel yourself for the inevitable market swings. Despite the warning of a potential 40% correction, Scaramucci remains a staunch optimist regarding Bitcoin's ultimate value. He confidently projects that the digital asset could reach the $500,000 mark within the next 5 to 6 years, a testament to his conviction in its adoption and utility. Speaking in a recent interview, Scaramucci highlighted a common misconception about Bitcoin, suggesting that the market's understanding of its potential is still in its nascent stages. He drew parallels to his own investment journey, recalling instances where he prematurely divested from major tech giants like Apple, Amazon, Microsoft, and Nvidia during their formative years. These past regrets have instilled in him a profound appreciation for holding onto fundamentally strong assets, a lesson he now applies to Bitcoin. "Learn from my 37 years on Wall Street, learn from my mistakes," he urged, underscoring the critical error of underestimating Bitcoin's transformative power. He firmly believes that selling such a powerful asset too early is the gravest mistake an investor can make. While acknowledging the current bullish sentiment pervading the crypto market, Scaramucci's cautionary note about preparing for a potential downturn serves as a vital reminder that market cycles are inevitable. He stresses that periods of strong growth are not permanent and that prudent investors must anticipate corrections. Scaramucci's predictions offer a balanced perspective, acknowledging both the immense long-term promise of Bitcoin and the short-term risks that accompany such a dynamic asset class. His insights provide valuable guidance for navigating the complexities of the crypto market, emphasizing patience, resilience, and a firm belief in the asset's fundamental value. But is this potential dip a sign of weakness, or a necessary pit stop on the road to unprecedented gains? We'll explore that next, as we uncover the surprising synergy between Bitcoin mining and artificial intelligence. The unexpected power couple: how Bitcoin mining and AI are revolutionizing capital efficiency. In a development that could redefine the operational landscape of two of the world's most talked-about technological frontiers, a fascinating convergence is taking place between Bitcoin mining and artificial intelligence. This isn't just a theoretical discussion. It's a practical evolution that promises to unlock new levels of capital efficiency and reshape how both industries operate. As the demand for computational power surges across both sectors, the unique demands of Bitcoin mining are proving to be a surprisingly fertile ground for AI advancements, and vice versa. At its core, Bitcoin mining is an energy-intensive process that relies on vast amounts of computational power to solve complex cryptographic puzzles. This process, often criticized for its energy consumption, is now being re-examined through the lens of AI. Innovations in AI are leading to more efficient algorithms and hardware designs that can optimize the mining process, potentially reducing energy usage and increasing hash rates. Conversely, the massive datasets generated by Bitcoin mining operations, along with the need for predictive analytics to manage operations and anticipate market trends, are providing AI with invaluable real-world application and learning opportunities. This symbiotic relationship is creating a feedback loop where advancements in one field directly benefit the other, driving a new era of innovation. Consider the operational side. AI can be deployed to monitor and manage mining hardware, predict potential failures, and optimize energy procurement to take advantage of fluctuating electricity prices, especially those linked to renewable energy sources. This not only improves the profitability of mining operations, but also makes them more sustainable. Furthermore, AI's ability to analyze vast amounts of network data can help identify inefficiencies or potential security threats within the mining infrastructure, bolstering the overall security and resilience of the Bitcoin network. On the flip side, the specialized hardware developed for Bitcoin mining, with its focus on parallel processing and raw computational power, is proving to be highly adaptable for certain AI tasks, particularly those involving deep learning and large-scale data processing. This cross-pollination of technology is leading to the development of more powerful and versatile computing solutions. The implications extend beyond mere operational improvements. As AI becomes more integrated into financial markets, its ability to analyze complex data patterns could extend to understanding and predicting cryptocurrency movements, including Bitcoin. The data generated by Bitcoin mining, which reflects the health and activity of the network, can serve as a crucial input for these AI models. This synergy could lead to more sophisticated trading strategies, better risk management, and a deeper understanding of market dynamics. The intersection of Bitcoin mining and AI is not just about making mining more efficient, it's about creating a more intelligent and interconnected digital economy. This wave of innovation is certainly exciting, but what about the big players? Are they quietly accumulating more Bitcoin, and what does that mean for the rest of us? Whales on the move, decoding Bitcoin accumulation and its market ripples. In the intricate ecosystem of cryptocurrency, the actions of large-scale holders, often dubbed whales, can send significant ripples through the market. Recent data and analyses are pointing towards a notable trend of accumulation among these major players, sparking considerable interest and debate about its implications for market dynamics in the coming year. Understanding whether these whales are buying the dip, preparing for a bull run, or simply rebalancing their portfolios is key to deciphering the near-term future of Bitcoin's price action. The term whale typically refers to an individual or entity holding a substantial amount of Bitcoin, often thousands or even tens of thousands of coins. Their trading activities, due to the sheer volume involved, can exert considerable influence on market sentiment and price. When whales begin to accumulate, meaning they are consistently buying and holding rather than selling, it's often interpreted as a signal of confidence in the asset's future value. This accumulation phase can precede significant price rallies, as increased demand from major holders absorbs available supply, potentially leading to price appreciation. Several on-chain metrics and analytical tools are currently highlighting this accumulation trend. Analysts are closely monitoring the flow of Bitcoin into and out of exchange wallets, as well as the net change in holdings for addresses that have held large amounts of Bitcoin for extended periods. An increase in the number of these long-term holder addresses, coupled with a decrease in the number of whales actively moving their coins, suggests a hodling mentality is prevalent among the biggest stakeholders. This behavior indicates a belief that Bitcoin's value will increase significantly over time, leading them to secure their positions and resist the urge to sell, even during periods of market volatility. The implications of this sustained accumulation are multifaceted. Firstly, it suggests a growing conviction among sophisticated investors that Bitcoin is a valuable store of value and a potential hedge against inflation, similar to digital gold. Secondly, it reduces the readily available supply on exchanges, which, if demand remains constant or increases, can put upward pressure on prices. This scarcity dynamic is a fundamental driver of value in many markets, and its application to Bitcoin is closely watched. However, it's also crucial to consider the nuances. Accumulation doesn't guarantee immediate price increases. Whales may be accumulating strategically, perhaps anticipating specific market events or regulatory changes. Furthermore, the market is not solely driven by whales. Retail investor sentiment and institutional inflows also play critical roles. Yet, the consistent buying pressure from large holders cannot be ignored. It provides a foundational strength to the market, potentially cushioning against sharp downturns and providing a base for future growth. The ongoing whale watch is therefore essential for anyone seeking to understand the underlying currents of the Bitcoin market. This accumulation by major players is a significant trend, but it's happening against a backdrop of fundamental beliefs about Bitcoin's purpose. What happens when those beliefs lead to ideological clashes? We'll look at that next. The battle for Bitcoin's soul, Saylor's crusade, and the institutional tug-of-war. As Bitcoin solidifies its position in the global financial consciousness, a profound ideological divide is emerging, shaping its future trajectory and institutional adoption. At the heart of this debate is Michael Saylor, a prominent Bitcoin evangelist and CEO of MicroStrategy, whose unwavering advocacy and strategic approach represent one side of a critical conversation about the digital asset's long-term role and governance. His public stance, often characterized as a fight for Bitcoin, highlights the tension between decentralized ideals and the increasing influence of institutional capital. Michael Saylor has been a vocal proponent of Bitcoin as a superior form of money and a reliable store of value, often drawing parallels to gold and comparing it favorably to fiat currencies susceptible to inflation. His company, MicroStrategy, has made substantial investments in Bitcoin, effectively making it a core part of its corporate treasury strategy. Saylor's approach is not just about investment. It's about a philosophical commitment to Bitcoin's potential to revolutionize financial systems. He actively engages in public discourse, educating, and advocating for wider adoption, often emphasizing Bitcoin's scarcity, security, and decentralized nature as its most compelling attributes. This strong advocacy, however, places Saylor and his ilk at the center of a complex debate within the broader crypto community and the traditional finance world. Critics and even some proponents raise concerns about the increasing institutional influence on Bitcoin. While institutional adoption is often seen as a validation of Bitcoin's potential and a driver of price appreciation, it also brings the risk of centralization and a potential shift away from the original ethos of decentralization and censorship resistance. The argument is that as large institutions with significant capital become more involved, they may seek to influence Bitcoin's development, governance, or even its core principles to align with their own interests, potentially compromising its decentralized nature. Saylor's fight for Bitcoin can be interpreted as a defense of these core principles against what he perceives as potential dilution from less committed or less ideologically aligned players. He champions a maximalist view, believing that Bitcoin's strength lies in its unadulterated form and that any deviation or compromise could undermine its long-term value proposition. This perspective often clashes with those who believe that Bitcoin needs to evolve and adapt to gain broader acceptance, potentially incorporating more features or accommodating different use cases that might appeal to a wider range of investors and developers. The implications of this ongoing ideological struggle are significant for long-term investment strategy. Investors must consider whether they align with the purist, maximalist vision championed by figures like Saylor, or with a more pragmatic approach that embraces broader adoption and potential evolution, even at the risk of some degree of centralization. The direction Bitcoin takes, whether it leans more towards its decentralized origins or embraces greater institutional integration, will profoundly impact its future as a financial asset and a technological innovation. The discourse initiated by Saylor and others is crucial for navigating these complex trade-offs and defining the future landscape of digital finance. These are some of the biggest stories shaping the crypto world right now, from bold predictions to technological mergers and ideological battles. We've covered a lot of ground, and the market is always moving. Stick around for a quick recap and what you need to know moving forward. And that's a wrap on today's Essential Crypto Briefing. We heard a prediction of a massive Bitcoin drop before a $500 K surge, explored the powerful synergy between Bitcoin mining and AI for capital efficiency, saw evidence of major whale accumulation signaling strong market confidence, and delved into the ideological clashes defining Bitcoin's future. Don't miss out on any of these critical updates. Hit that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto intelligence, and ring the notification bell to stay ahead of the curve. Follow us on all social platforms for more insights and join the conversation. We'll see you next time.